What's up, guys? Welcome back to my channel. Today, I've got 3 stocks in the month of October at 52-week lows that I think you guys need to be picking up. They will provide potential fantastic long-term shareholder value. And I think these stocks are going to be amazing for your portfolio. Now, if you guys enjoy more content like this, make sure to drop a like because I break down all 3 stocks, which will provide fantastic value for you guys. Subscribe if you haven't already, but let's get into the video. Now, spoiler, I do talk about these stocks in my channel, and if you're wanting a more in-depth analysis of the stocks I speak about, I do have separate videos for you guys, which I'll make sure to link in the corner. So check that out if you are obviously wanting more detail on each stock that I talk about. Now let's jump into my first stock, which is Overstock. Now, truthfully, the wider market has hit a lot of these stocks very hard, especially in the last 2 to 3 months. Back in August, Overstock was at $38 at one point, and now since then, it's fallen all the way to $15.72, which is just insane. But the value in Overstock is still very much there. And this is where we get into some of the recent developments of Overstock. But with the recent news of Overstock buying the Bed Bath & Beyond assets, specifically the IP, this is going to be a massive game changer for Overstock. And the reason why I believe it's so significant is because the price that they bought it at. They bought it at $21.5 million, which is just absolutely ridiculous considering the massive name behind Bed Bath & Beyond. So why do I think Overstock's business model is going to work on top of Bed Bath & Beyond? Well, they use a drop shipping model, which helps with margins and consolidates any additional costs. As they don't hold inventory in downturns and recessions, there's no need to liquidate, as they're only essentially charging an added fee through their website for the commission that they're getting on that website purchase. So this is going to be the biggest bonus when compared to Bed Bath & Beyond's downfall. The problem with Bed Bath & Beyond is they were way too inventory heavy and they had too many stores that were too expensive. As Overstock just uses an online model, it's so much more efficient than Bed Bath & Beyond. Now, the other thing which I think we need to align is the acquisition of Marcus Lemonis, who has suddenly become a director in Overstock. And this is one thing in Overstock which was lacking, which was a directors and insider purchasing, because Overstock had very little institutional and insider buying at only just under 2%. So now we're starting to see actual commitment into Overstock share price, which gives us a belief that this stock is undervalued. Let's talk about what you can actually get for Overstock now. It's trading at $15.72, like I mentioned, but the biggest thing is around that market cap. It's currently trading at a $710 million market cap, yet the enterprise value is at $409 million. And this is because Overstock has net cash of $300 million. They've already committed to $100 million in buyback, which they've executed on $80 million, and there's still $20 million left, which I expect them to potentially buy, with earnings coming up in October the 26th. So watch out for that day. Moving over to the financials now, the biggest thing was around revenue declining. As you can see, from 2020, it went from 2.5 billion, and now we're almost $1 billion lower in the last 12 months. But this is where the Bed Bath & Beyond acquisition can potentially re-accelerate the revenue in Overstock, which could hopefully help with the share price as well. On Overstock's balance sheet, they have $342 million in cash. And like we mentioned, they have very little debt, and they have net debt of $300 million of cash, essentially. Now, not only this, the biggest thing we need to consider is this long-term investments, which currently is very, 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 very undervalued for Overstock. So let's have a look at exactly what these long-term investments are. This section right here is incredibly interesting, as Overstock bought Medici Ventures a few years back, and this has the potential to 10x potential in Overstock that no one has really considered. Companies like T0 are focusing on a blue ocean strategy, if you've ever heard that term before. They're essentially going after illiquid markets through security tokens and ensuring that private equity is able to become more liquid by using this potential blockchain and security token method. Now, other companies inside like Bit are also really interesting. They're focused on CBDCs, essentially ensuring that countries where they have corruption or very difficult payment systems, they're ensuring that by using CBDCs, they can become in much faster, and this can help with social inclusion, financial empowerment, and then economic growth for countries and companies. Now, another really interesting business, which is one of my favorites, is Grain Chain. Now, this is a company that prompts payments to suppliers and farmers through the ag tech space. Now, what they're essentially doing is selling data insights to these different companies that can ensure that suppliers are getting paid fair, that commodities are the right commodities, and ensuring that this is all tracked through the blockchain technology. This company had over $100 million buyout from a potential investor. However, the CEO declined it because he believes this company can be worth potentially $1 billion, maybe even more. Now, we own 30% of Grain Chain specifically, 55% of T0, and then around 64% of Bit inside. But this can still have huge ties for a company that like Overstock, which is trading at just under $700 million market cap with 300 million in cash. So this is my highest conviction stock, Overstock. I think it's one of the best companies I've personally ever seen. There's fantastic value here. And if you guys want more in-depth analysis, make sure to check out the video in the corner here. Now, my second stock is another really interesting small cap, which has been hit extremely hard and is at 52-week lows. And that company is Hims&Hers. So Hims&Hers is another small cap which has been hit incredibly hard with liquidity rolling out of small caps like crazy. Now, back in May, it was trading at around $12 a share, and it's already back down at $6 a share, and that's 50% lower than it was before. However, if we take a look at the year chart, it is up 11%. However, you can see it's very volatile. Now, at a $1.3 billion market cap, there's still some fantastic opportunity in this company, and the growth in Hims&Hers has been immense. So what's great about this company is their unique approach in rapidly scaling with their strong margin profile. You can see that their subscriber growth is at 74%, going from 748K in Q2 22 to 1.3 million from Q2 23. They're ramping up very hard, and it's improved their revenue to 83%. They're now gone from 130 million in the quarter 2 22 to 207 million Q2 23. This company is immense in scaling, and it's also starting to become more profitable, as we can see that their adjusted EBITDA margin has now turned positive, going from Q2 22 at -7% to 5% in Q2 23. Now, not only this, they also have a recurring revenue business model, and they're a 75% growth margin profile. So once this business really scales, it can become extremely profitable. So if you haven't heard of what Hims&Hers do, they essentially provide personalized doctor-backed treatment plans. And this is to help with things like ED, hair loss, early climax, and skincare. These are all sorts of personalized solutions which are very tailored towards certain individuals, which can help with reoccurring revenue in the future. Now, this business has been scaling like crazy, and we can see that in the marketing and the financials, which I'll get into now. A side-by-side view when taking a look at the sales and marketing and revenue, we can see that there's a very big correlation. They've clearly scaled up using that selling and marketing expense to help drive future growth in that revenue number. And if we take a look at the numbers now, they've gone from over 150 million in 2020, and since then they've grown all the way up to $710 million, which is fantastic, with a compounded annual growth rate around 80 to 90%, which is immense. Now, not only this, we can see the gross profit margin has been expanding. Now, this means they are becoming more profitable and that they are actually providing better cost of goods sold while increasing that revenue at a faster rate. Now, the other thing is going to be around obviously the sales and marketing expense. We can see that's been growing very large, but the revenue has warranted this selling and marketing expense. There is one red flag I would consider, which is the outstanding shares, which has grown massively. They've clearly used a lot of that marketing expense and growth to help drive through outstanding shares that they diluted shareholders, which isn't great to see, but it has slowed down from kind of 2021. And now it's only around the 200 million mark, but they are still expanding, which could be a concern. So, quick summary of Hims and Hers. It's a great company in a great growth space. This telehealth company has recurring revenue through that subscriber growth, and that personalized treatment plans can help eternalize a fantastic business model and brand itself. Not only this, obviously, that selling and marketing is growing alongside that revenue number, and this business still has great revenue ahead of it. So, you could be getting in at a really good time. They're not only just becoming profitable, that will help with valuation, but they are also diluting slightly slower as well, which means that this business could be a really good time to buy as it matures and gets even greater in growth. Now, my third stock is PayPal, the payment provider at 52-week lows, which has been destroyed in the last year. And I'll be breaking down why I think this company has fantastic potential. So with PayPal stock being hit down 40% on the year, it's trading at $56 a share. Now, this company is trading at a $61 billion market cap with a 15 PE ratio. Now, this company has fantastic companies inside, and there's been a recent change in management which could propel this company much higher in the future. So one thing that was really holding back PayPal was the vision of the previous CEO, Dan Schulman, and where he was going to take PayPal next, which was a massive concern, which is why they brought in Alex Chriss as the next president and CEO of PayPal. Now, what I really like about Alex Chriss, and I've done a full breakdown of Alex Chriss, but the biggest thing was around his background in product development. Now, this is something that can really help PayPal, especially with the companies inside like Venmo and Braintree. These companies have massive potential, and Alex Chriss can be a fantastic driver in growing these smaller businesses to a much larger scale. Over to Venmo's growth now, you can see from 2019 all the way out to 2026, the amount of subscribers and users of Venmo. So back in 2019, there were around 41.5 million users, and that scaled up to 2023 at 85.1 million users. Now, this is estimated to keep growing all the way up to 2026, which is the current numbers we have at 102.3 million. So this is something inside PayPal, which is extremely undervalued right now. At a $60 billion valuation, we're basically getting Venmo for free if you include the legacy business of PayPal, and then you add on Braintree as well, which I'll speak about. A lot of PayPal's growth has been driven by a company called Braintree inside. Now, Braintree offers white label service checkouts for businesses and online checkout purposes. Now, as it's an unbranded transaction, the margins are much lower. And this is why in quarterly earnings, this has definitely weighed in on PayPal's performance in their transaction margin. Now, while their legacy business is still growing at around 6.5%, when you compare that to the unbranded merchant business, it surged to 30% according to Monday's earnings presentation. So this is a massive driver in PayPal's growth, but it is slightly waning on their margins. Now, I think the biggest thing right now on PayPal is the valuation. And I think this company is so cheap, people can really pick up some great cheap shares right now. If we take a look at some of the valuation metrics, we can see that on an enterprise to EBITDA basis, this is at 8. Now, PayPal would normally trade at around 20 if you're looking back into 2021 numbers, and even 2022 numbers at 15 or 14, this company is far too low. Then if we take a look at the PE metric, another metric which is significantly far too low for a company that's still growing numbers. Now, this is trading at 10.8, but again, they typically trade at around the $20 range or 20 to price to earnings range in terms of 2022 numbers. So if we then take a look at estimates, now estimates is where we are still got great growth potential. You can see that PayPal is still expected to grow around 9% in 2024. Now, for a company that is still growing 9% with really challenging macroeconomic environments, then this is still very undervalued. Then if you take a look at EBITDA, now this is even growing faster than revenue at 12%. This will only help the valuation metrics in the future, and this is something that you need to consider when purchasing PayPal. In 60 seconds, I'm going to summarize why you should be picking up these three stocks at 52-week lows. Now, Overstock has been hit hard, obviously, by macros. However, they've got 300 million in cash with the potential to explode with some of the businesses inside. Now, with alignment of directors purchasing shares, this company can propel back up to $30 very quickly. Now, second is Hims&Hers, a fantastic telehealth company with huge growth factors. They're expanding throughout their marketing expense, and it's clearly working. The valuation has come down very nicely, and this is a great stock for the long term. Now, third, PayPal. Venmo, Braintree inside with new direction and vision with Alex Chris, a fantastic company at a valuation which is far too cheap. These are three stocks which I think would be great for any portfolio. Now, I personally own all three, which is why I can say that I really like these companies. But make sure you're doing your own due diligence when looking into each three. And I have separate videos on all three companies. Now, if you guys enjoyed this video, make sure to drop a like, subscribe if you haven't already, and I'll see you guys in the next one. Thanks for watching.